Hello, welcome to Any Answers Answered for May 2023. Obviously, we're still in the aftermath of the budget and the finance bills and what have you. And so our first question this month ties into one of the confusions that seems to be out there as far as associated companies and the like are concerned. The question, Tim, comes from a VCM accountant, and it relates to, certainly the largest corporate tax issue in the last 12 months. Associated companies and property investment companies. The question is, I'm just refreshing my knowledge, says VCM accountant, on the associated company rules. I have a number of clients that run businesses through a limited company and also hold a buy-to-let property in another limited company. I can see from the legislation that we can ignore companies that have not carried on a business. It's quite a claim. Just wondering if a property company holding residential buy-to-let would be treated as carrying on a trade. Now, even VCM accountants at this point in their question has moved from business to trade, and this is a topic we need to be incredibly cautious about.
Yes, and it's a very important question, as you say, and I'm intrigued by the way in which there are only 3 comments at AccountingWEB posted to this question, because it is so important. Well, the answer basically is that companies will be associated where they're under common control, and this will then trigger an equal division of the lower and upper profit limits that came into effect at the start of this financial year, 1st April 23. The 50,000 and the 250,000 have to be divided equally, which will accelerate the point at which the marginal rate of 26.5% comes in. And we have to consider any exceptions to the inclusion of these associated companies. And the first exception to consider is that if a company is a dormant company, then it can be disregarded. However, a company operating buy-to-let properties is certainly not dormant. It's not a question of whether it's carrying on a trade or a business. It's a question of whether it's dormant or not. So no, they cannot be ignored. The second point I'd make is that even though a holding company, let's suppose you've got a holding company owning a couple of subsidiaries, that company itself is not dormant. It could nevertheless be disregarded if it is what I would call a pure holding company. In other words, it does nothing at all except hold the shares of the subsidiaries, and it could take dividends from those subsidiaries and mandate them onto its own shareholders, but it mustn't have any other business or trade of its own. Otherwise, it will be counted for the purposes of the small company rate legislation. But then there's a further point that is relevant to this question from VCM accountants, and that is that if a company is a close investment holding company, CIHC, then that company has to be counted as an associated company if it's under common control. However, the CIHC itself will have to pay tax at 25% on the whole of its profits. In other words, it doesn't get the benefit of the small company rate on its share of the profits up to the lower profit threshold as divided. And if you have 2 companies, one of them, say, a trading company, and the other a property owning company, well, the 2 companies, if they're under common control, are associated. But if the property company is a CIHC, then it doesn't get the benefit of the small company rate. But tax is never simple. There's a further twist, which is that a property company letting its properties to unconnected third parties doesn't get treated as a close investment holding company for this purpose. But if the property company owned, let's say, the property that the associated trading company trades in, then it does count as a CIHC, and there's a double jeopardy there because the trading company will have a divided lower profits and upper profits limit, whereas the property owning company will be at 25% on the whole of its property income. So an awful lot to that answer, and perhaps one can understand why there are so few comments on AccountingWEB.
I think we can all see why people are still scratching their heads a little bit as to what rates have to be paid and also when tax has to be paid. Quarterly payments have to be factored in as well. Anyway, that is our first question. The second question comes from Peter Harding, and Peter's question is to do with fees paid by an employee to an employer. Situation, I was going to say it's relatively common. It's certainly not rare. I think that's fair to say. An employee who recently left the firm was obliged to pay back several thousands of pounds relating to training costs, which her employer had incurred for her training while she worked at the company. The deal was if she left within 2 years of the training, she'd have to pay the money back. Guess what? That's what's happened. Is it possible, asks Peter, that she can claim this cost as a tax deduction, i.e. should it come off her gross taxable salary for the year so that she can get an income tax rebate? I guess on the value of the training is the amount we're talking about here. Tim, what do you think?
Well, the simple answer is yes. And this is what we can call negative earnings. And although it's not frequently met in practice, there has in fact been one tax case on it, which is referred to in the final comment that's currently on AccountingWEB on this particular question, posted by Tax Digital. And that refers to the case involving a Mr. J. Martin back in 2014. And that case confirms that where an employee has to repay an amount, in Martin's case, it was repayment of a bonus because he left earlier than the time allowed for when that bonus payment was made. Negative earnings are then allowed as, if you like, a loss claim under Section 128 of the Income Tax Act 2007. But of particular interest, I think, is the way in which this can apply to an accountancy trainee. And many firms now have this sort of issue where the firm that incurs the cost, putting an accountancy trainee through training, includes in their employment contract a clause under which if the employee leaves within a particular period, here it was 2 years of the training cost being incurred, then the employee must repay. Of course, it's something that's long happened in the airline industry because airlines like EasyJet, British Airways, etc., spend a lot of money type rating new pilots on new types of aircraft, and they don't want them then leaving, having spent 100,000 or so on training them, and going to work for a different airline. So the contract will require repayment. Now, under Section 128, as I say, it's a form of sideways relief. The main condition is that the negative earnings arise in the same tax year in which you are still employed in the employment or office in respect of which the negative earnings arise. And they would, of course, in the first instance, be set against any employment income in that year. So if the employee has to repay, let's say, £10,000 in the same tax year in which their earnings were 30,000, then yes, that reduces their earnings to 20,000. But a particular point is that if the repayment and the departure comes early in the tax year, suppose the employee leaves on the 12th of May, so just over a month into a new tax year, and their P45 shows earnings for that year of only, let's say, £11,000, but they've had to repay, let's say, £15,000, well, they've then got a negative figure of the excess 4,000, and that can be offset sideways relief in the usual way against total income of the year in which that negative figure arises and or the previous tax year. So it is a fairly familiar way of getting loss relief, but in a fairly unfamiliar setting.
And as you say, hugely important that we pick up on the fact that we cannot carry that forwards. It's same year or previous year, just a sideways loss relief claim possible. Hopefully useful to Peter and to VCM accountants and lots more of you besides. Do keep posting your questions, and perhaps next time we'll have a look at one of your questions. For today, bye-bye.